Hi, I'm Keith McCullough, and welcome to another Real Conversation. Going to have an interesting one, suffice to say, with Cormac Kinney, who's the founder and CEO of Diamond Standard. Welcome, Cormac. Thanks for making the time.
See you again.
Yeah, the topic obviously that we're going to get into here is diamonds, but we definitely want to get into diamonds as a digital commodity or currency. Some people might call it a currency, and it's actually an interesting debate. Like, our subscribers, our followers are going to want to potentially put this within the framework that we call a full investing cycle framework, where you have a diversification across different alternative investments. So we've talked to different people about fine wines, art, et cetera. And I was quite excited when I saw your initiative, because A, it doesn't exist, and B, it's new as a result. So first, just want to give an opening volley, on why you're doing this and how you thought about starting it.
Well, the funny thing is, I was never interested in diamonds. My background was in fintech. I spent about 10 years designing trading systems for both buy side and sell side. And that company was NeoVision, got acquired by SS&C. And our largest investors were people like Deutsche Bank, which is how I met our common friend Ralph, and built systems for him. But after that, I ended up moving into the world of statistical arbitrage, and I ended up being a quantitative PM for about 6 years. I ran about a $500 million fund. I started at Amaranth, which was it didn't work out, if some of your viewers recall. But I ended up raising about $500 million from Paul Tudor Jones and Izzy Englander, and eventually brought my fund to Millennium, which is where I ran it at a very large size. So my background is trading and obviously quantitative technologies like automated market making, exchange systems, statistical arbitrage, and analytics, et cetera. But my wife is a famous jewelry designer named Mimi So, and we're married 20 years now. In those 20 years, accidentally, I learned too much about diamonds. And I came to realize diamonds are a $1.2 trillion asset as a natural resource. That's as much as all the silver, platinum, and palladium combined.
Yeah.
But investors could never use diamonds, even though they're a hard asset, natural resource. An investor could never touch a diamond because there's no standardization. Mm-hmm. Every diamond's different. So there's no price discovery process that's repeated and consistent. When two people trade a diamond, their deal is secret. So there's no transparency. There's no exchange. There's no centralized limit order book, all these things that we were used to. And as a result, there's simply no liquidity for diamonds. There's immense friction whenever you want to trade them. And for a institutional investor like a BlackRock, which doesn't own a single diamond yet, there's no way to mark to market. So they simply can't hold it. The breakthrough for me was that I came from these two really different extremes of really deep understanding of diamonds and a deep understanding of trading and computer science, which is my education from Carnegie Mellon. And I realized that the diamond standardization challenge was a computer science problem. And that was my approach. It's only taken me 5 years, but you'll be surprised because we actually are launching the spot commodity, futures on the CME, options on MIAX, and an ETF on the New York Stock Exchange, all within about 14 months.
Which is super exciting, and that gets, that starts to potentially solve for these liquidity, friction, et cetera, problems that you got into. And I want to get into that, but then let's just go back. Like you just said a whole bunch in a very short period of time. As somebody, and I appreciate that, because that's somebody who can condense all their experience and how they've thought about entering a new market is kind of the way of the world these days. And there's a lot to say about transparency, accountability, pricing, real time. and people having access to things like this. When you said that, like 1.2 trillion is the diamond market, that in context, like gold's around 9 trillion, and as you said, silver is less than a trillion. And if we're right on silver, maybe silver will be more than a trillion. But is part of the problem the unit pricing? And I mean, on top of the whole thing, I mean, I'm assuming that an ounce of diamonds is certainly worth a lot more than a lot of the other things you mentioned.
Yeah, well, an ounce of diamonds in aggregate is about $300,000 compared to gold at its all-time high is 2,000 or so. No, the real challenge is there's no fungibility, and that's what we solved. That's the foundation of everything we've done. Is we've created a fungible diamond commodity where they're all the same, whether they're made today or in 25 years. We have a coin and a bar that are always standardized. And so when they're traded, all of that liquidity is concentrated into one spot traded commodity that's the underlying asset for everything else, for futures, options, and ETFs. So the key was transparency, standardization, leading to price discovery. And that price discovery is what enables us to create all the markets on top of it.
Yeah, can you go through that? Like, currently, what is the lack of price discovery? So, what is not price discovery in the diamond market as you see it?
Well, the diamond market is all based on this Rappaport list, and the Rappaport is a survey where they survey wholesale dealers and ask them, tell us, please, what are things trading at? And I don't want to say they're all liars, but the prices are you could never trade at these prices. And a estimate can never be the foundation for a mark to market. You have to have a market maker, which provides a actionable bid, or you need to have a visible cross between two counterparties in order to have a legitimate mark to market, at least in the eyes of people like the SEC that we care about and the CFTC. So we had to first start by making a product that was fungible.
Right.
And then that fungible product, the market tells us the price. We never, like, it's the same as a gold mine. When Barrick Gold makes a kilo bar, they don't say, this kilo bar is so beautiful, I love it, it's my favorite, I want $3,500 an ounce for my kilo bar. No, the price is on the CME or the LBMA, and that market fix decides the price for that commodity on that day. And we've created the ecosystem and the structure of a centralized limit order book, for example, with a depth of market and the ability to force price discovery. Because we're the world's first market maker, we enforce the discovery of about 16 million prices a day, and that becomes the foundation for a market traded commodity.
I think when people hear that for the first time, they're probably like, that sounds ridiculous. Like, I mean, it's really, even something that is, it's liquid in terms of being able to consume it, like wine, but it's highly illiquid, high-end wine. You have LiveX, at least you have some kind of a bid-ask system where people can see trades and start to have a real market. To have a market that's based on a survey, I mean, that is, I could see if it was something smaller, but this is a massive market when we talk about a multi-trillion-dollar market.
Well, that's how it was. So Rappaport is the survey, and that's why diamonds never became a market-traded liquid commodity. We've replaced all that. We are the world's first and only market maker. We've built the world's first and only centralized limit order book for loose diamonds, and the world's first and only exchange that provides global settlement, custody, price discovery, and everything that we're used to with a commodities or a securities exchange. We've created that for diamonds. But the key is that we're the market maker.
Yeah.
And we bid every day on 16 million varieties of diamonds. And we force the market to tell us, by buying a sample of those diamonds, we find out what's the value. So we have absolutely no surveys, no estimates, no subjectivity whatsoever.
The survey
It's all
thing
pure
is
math.
the survey against math, like it's the year 2021 for God's sakes. I mean, it still sounds so prehistoric in terms of how it is. Can you define? You said loose diamonds. What does that mean?
So I should show you the commodity because that will help put a lot of things into context.
Yep.
So as I mentioned, we make the world's first fungible diamond commodity. And this is what it looks like. These are diamond standard coins. Each coin, as you can see, contains diamonds. There's diamonds, each one has about a dozen diamonds in it.
Yep.
And these diamonds, you can never say I want the exact same diamonds in every coin because there's millions and millions of varieties. But what we can prove through radical transparency and we make everything public. These two coins, even though the diamonds are different, slightly different, they always add up to the same geological content. Mm-hmm. And if you remember buying a diamond, diamonds as they get larger, bigger, higher carat weight, as they get more flawless, as they become more colorless, like D color, diamonds' value goes up exponentially. And that's part of the challenge, is that diamonds are nonlinear. Mm-hmm. As they get bigger, they double, triple, quadruple in price for every additional carat. As they become flawless, they become dramatically more valuable. Every coin that we make adjusts for all of those characteristics, and we can prove that they're always the same. Whether we make these both in the same day or we make them 25 years apart, these two coins are the same. The way we do that is through statistical sampling and statistical arbitrage. As I mentioned, we use in these coins every possible combination of geological characteristics, the carat weight, color, clarity. That means there's about 16 million varieties of diamonds that can fit in the coin and also our bar. The bar is all larger diamonds. As a market maker, on a daily basis, we bid on all 16 million types. Our bids are limit orders. We can't buy 16 million diamonds, and there aren't 16 million available. But we've invented a new type of automated market making system where all of those characteristics are in a matrix, because there's no exchange in the world that has 16 million order books, for example. We've developed a way to do that. What we buy is a public and statistically valid sample of all 16 million. And we have to buy a little bit of everything, every color, every carat weight, every clarity, every possible combination. And we make that public. And our bids are public. So the market sees our bids, the market being the diamond vendors of the world. Right now we have about 93 of the largest diamond vendors that are supplying about 10 billion of depth on our loose diamond exchange. So to answer your question, what we're bidding on are the loose diamonds, every possible diamond that can be inside of this coin. Every day we make a bid and we force price discovery. But what we buy is a statistical sample that we make public, and we can prove that today's sample and the sample 25 years from now, we can prove that they're the same. And so the market knows the commodities are the same.
So to put this into my language, because that's diamond language, like to me that's like a factor-based model where I'll use the example that people know that I use for wine. I use a factor-based model with three main factors. One would be the region, one would be the vintage, and one would be the rating. Okay, for whatever reason, those are the three factors that have the heaviest weights. So when I think of the three-factor model, those are the things that I think the most about. So you said it's carat weight, color, and clarity. So those are the
There's other minor ones.
But those are the three
like
main factors. If I'm trying to get to this, if I'm trying to get to a wine price, a bid-ask price that I'll believe, and I'm trying to get to a diamond price, I'm trying to get to the geological weight or content weight of those three factors, correct?
Correct.
Okay. Then I take a shitload of supply and I become the market, and I validate those factors and the geological content, and the market agrees or disagrees with that.
That's correct.
How would they disagree with that? Like, how would they know that there's like wine? As I know, we don't know if one of the bottles, if I buy a case of something quite valuable, I don't actually know, and actually I don't care if it tastes terrible or one bottle's not good, because in the end I'm not going to drink it anyway. I'm just storing it as value because people believe that. So is there that same example, like you could have in that coin, two of the loose diamonds or I don't know, fake, fraud, whatever? Is that possible?
Well, to start the beginning, because that's a great question. We had to be very careful in designing this structure that we never put our finger on the scale. We never set the price ourselves of the contents or of the commodity.
Okay.
We don't price fix in market terms. So there's 2 points in time for our commodity. There's the initial public offering, which is coming up in about 2 weeks, and there's every day after the IPO. At the IPO, we didn't set the contents of every coin. The coin is being sold, and it's under regulatory approval, by the way. The coin is being sold for $5,000 per coin. We take those proceeds and we buy $5,000 worth of diamonds, using this statistical sampling process. Obviously, it's a much larger scale. We're buying about 60,000 diamonds over 3 days. That sample we make public, and it has to be all those yield curves. And they are yield curves because it's not the yield curve the way a treasury is, but it's the yield curve of the earth. So we're discovering from the market through our bidding, where we must buy a little bit of everything, we're discovering what are those yield curves. The market tells us. We don't decide the factor weightings as you referred to. But once we discover that yield curve as of the IPO, that's public and permanent, and that is the diamond standard.
Right.
After the IPO, every single day when we make a batch of coins or bars, we have to replicate that yield curve, and we have to do it publicly, and we have to pay whatever it takes. So we never tell the market what diamonds are worth. The market always tells us.
Love that.
Similarly, we don't tell the market what the coin is worth. The coin is being traded on digital exchanges. I know you're interested in that. We'll talk about that. But the coin is being traded on a lot of digital exchanges, and in about 5 or 6 months, it'll also be traded on the CME Globex. That market price discovery tells us the price of the commodity on a daily basis. We're more like the agency in the middle. Our job is very simple, is to make these the exact same forever. That's it.
So I love this. This is fantastic. Because, and again, you mentioned a couple things that have existed across a lot of markets that actually do trade with transparency, i.e. price fixing. So what do you think the nonlinearity could be? Do you have any idea? I guess by definition, the question nonlinearity is not going to have an answer. But once let's just argue that this becomes successful. What kind of supply could potentially just come out of wherever in the world all of a sudden because they know that they can monetize that?
Yeah. So the supply of diamonds is kind of mysterious. What's interesting though is that people think De Beers has a big stockpile of diamonds. They absolutely don't. They've got 45 days of supply on a normal case. Right now they have more because of COVID, but they're a public company owned by Anglo American. We know their inventory. It's public. Alrosa, which is the Russian mines, that's a little less known, but believe me, my suspicion is they're selling their diamonds for cash as quick as they can all the time, and they don't have a stockpile either. But the diamond industry is like a triangle where there's really only 7 mining companies at the top, and their total output is about 30 billion per year once it's all cut. So it's at its maximum value, it's about 30 billion. We already have institutional indications of interest of over 2 billion for our commodity. So we expect that we're going to be consuming 5+ billion pretty quickly, which would be dramatically swamping the new diamond supply. However, there's 100 years of pent up supply that's owned by consumers.
That's what I meant. Yeah.
That's really our mine. We're mining the consumers and the supply chain, which are probably 100,000 little diamond vendors, but we're mining that supply. And by us providing price transparency for the first time and liquidity and much lower friction when you want to sell a loose diamond, we believe we can access that supply in a way that's never been accomplished before. Right now, nobody sells their grandmother's diamond because they go to the diamond dealer and they see a very similar diamond for $10,000, and the diamond dealer offers them $2,000.
Right.
And they go, why am I going to sell? I'll just keep it.
Yeah, exactly. So can you just repeat that again? There's 7 mining companies that produce approximately what per year, and then is
30
there
billion.
30 billion, and then what is there a projection for what the consumer has?
That's about the 1.2 trillion.
That's the market,
and
okay,
that's an estimate from Paul Zimnisky and others, for example, who's a very experienced diamond analyst. But 99% of all diamonds, and we're talking about gem quality diamonds, not industrial, it goes only into jewelry. There's a few family offices that may buy diamonds, some individuals, but we believe that this commodity will untap a very significant institutional demand, because diamonds are a hard asset. And this is the macro environment where everybody wants hard assets, silver included. Silver, gold, everything's near all-time highs. Diamonds are zero penetration in the portfolio allocation of institutions, but they have negative correlation historically to stocks, bonds, other commodities, even gold.
Yeah.
Diamonds have a negative 0.4 correlation to gold over the last 30 years, and they've outperformed stocks and bonds in the last 2 economic upheavals. If you look at every other precious metal, gold, silver, platinum, palladium, even rhodium, which has no futures contracts, the others all have futures, investors globally own at least 15% of each of those metals of the above ground supply.
Yep.
30% of gold because of central banks. BlackRock doesn't own a single diamond. So what we believe is that 15% is the pent up demand from the investors of the world for a deliverable hard asset that's fungible, mark to market, and is available as an ETF, futures, options, et cetera. So we believe that over the next, I don't know how long it takes, maybe 7 to 10 years, we believe that investors will buy 15% of the world's diamonds as a store of wealth, as a hedge. And because it's a secular phase of position building, I think diamonds are going to be an incredible appreciating asset over those 10 years, because it's one-way demand from institutions, pensions, and endowments building positions from zero.
Yeah, I mean, that part of it I'm absolutely willing to believe, because we have fully loaded with, not to get into a debate about modern monetary theory or the debasement of the dollar from this cyclical level that the dollar's coming away from, and it's breaking down from. This is why commodities as an asset class, as you know, it was shot for dead up until the cyclical bottom that it put in the middle of last year, and now things are starting to get much more interesting. This is actually, on a lot of levels, the commodities asset class was underowned, obviously, but you start to get into these discussions about what is the true value that I want to own, or that I want to call a store of value. Now, back to the way that I look at things, in addition to the factoring of it all, I think what you said is going to be really important, at least for me. Like, when you talk about the correlation of the asset, and you talk, or at least I'll write a lot, and I'll speak to the volatility of diamonds as an asset. I can't do that, Cormac, until I get it trading in futures and options terms, because that's how I price it. Like, I price it daily. I couldn't do that with Bitcoin. People said to me, well, why don't you have an opinion on Bitcoin? I said, well, my 13-year-old has a better opinion on Bitcoin until it trades its futures and options, because I can't measure and map the bid-ask on vol. the vol of the asset versus what people think it is or thought it was. The bottom line is that people don't know what the hell it is. So that's where we come in, right? So this, to me, is the real floodgates that you're opening here. The futures and options, the trading, the transparency of it all. That, to me, may show us that what you just said is changing too, right? I mean, I assume that you're open to that idea.
So here's what's interesting. We're going through an adoption curve, right? Our first product is the spot coin. Mm-hmm. And we'll talk about how it's traded digitally. This is actually a computer. There's a wireless computer chip in here that stores a blockchain token.
That's cool.
So this sits in the vault of a bank like JP Morgan, and people just trade the token. Mm-hmm. And so it'll be extremely low friction and liquid that way. But how many people own spot commodities? Well, it's a small market, and it's not available to the UBS clients, for example. So there's going to be a phase where it's only being acquired by gold bugs, silver bugs, people who want to take possession or use our custodian. And we use the same custodian as the CME for their gold. But we've already signed an agreement. We are launching a futures contract on CME Globex. That should take about 4 or 5 months. But as you point out, that opens up a huge new source of liquidity, demand, and price discovery. So once you have a futures contract, now you have a national market price where institutions can start to build positions. We also have options, which will be launching on the MIAX options exchange. Subsequent to that, so that will open up an additional source of demand. But we've also have an agreement with the New York Stock Exchange. We have a ticker, DIAM, and we'll be launching an ETF in partnership with kind of a who's who of the ETF world. But we'll be launching an ETF. It's physical, like GLD, it's holding it. And that makes this commodity available to the Merrill Lynch, UBS, RIA world of customers. Finally, at some point, diamonds will get added to the Goldman Sachs Commodity Index. And there's a lot of funds that track that and simply will allocate kind of like the S&P 500. So each of those data points are unlocking a new source of demand and bringing a new customer to this market that will continue to drive, position building of this asset up. That's what I'm talking about. This secular phase of position building is just going to keep on banging with new inflection points of demand. So believe me, I'm telling all my friends and family, load up in the IPO. The IPO is only 25 million, so it's kind of constrained. But as the earlier you build a position, the more of that secular demand phase you benefit from.
Yeah, 25 million, I'm assuming you mean 25 million coins?
No, $25 million.
$25 million? So it's
worth of coins, which is 5,000 coins.
Oh, okay.
But that's just the first day offering. It's mostly sold out already. But one thing that we really wanted to do, and the reason this took so long, is we held the regulators' hands with us. Yep. And we have regulatory approval for this commodity. It's produced entirely under regulatory supervision. The offerings, the escrow of client monies while we're buying the diamonds, all of that's supervised. It's all audited by Deloitte, which has been our partner for about 2 years. We've worked with Deloitte. So that regulator, which is for the token, our regulator is the Bermuda Monetary Authority, simply because the CFTC doesn't regulate tokens. so we had to find someone that would. And Bermuda's been fantastic. They're a very serious regulator. They're not like other countries. They're a serious monetary authority with the U.S. Compliant exchange, et cetera. But anyway, our regulator limited our initial offering. I like to joke to see if we steal the money, which obviously we're not. But they wanted to give us a $25 million limit. And then we have to do an audit by Deloitte where we have to do things like KYC and AML, anti-money laundering, verify everything that we say, and then we'll have unlimited rights. and we'll have a continuous offering of the commodity to fulfill demand.
Yeah, for someone like me, like who's a gold investor, and I trade my hedge on the paper gold side, which is GLD. This, to me, like what this sounds like is the exact same thing. Instead of my gold coins that I never sell, I short GLD quite frequently. I shouldn't say quite frequently. Actually, yeah, these days I've been shorting quite frequently, and it does trigger people that are gold bugs, as you say, or the former silverites, or whatever it is. I find having the ETF, once you get to that point, then it's full game on, because now I can go bigger in my physical because I can hedge it with the paper. And I think a lot of people struggle with that, because when it comes to something like this or gold, and I hope you don't take offense to it, people have a belief system about certain assets that they just can't shake. They can't go both ways. They can't hedge it. They never would. They wouldn't know how to. So there are a lot of issues there. But I agree 100% that once we get into the depth all the way through from futures and options into an ETF, that this is going to, I don't know how it wouldn't work. Unless diamonds are just not what people want to hodl, if they're going to do it with rhodium, why not?
I can tell you from firsthand experience, people like diamonds. So we're not worried about that. But your point about hedging is a very good one. One of the companies we work with is Tiffany's, that intends to be a member of our exchange because they want to buy next to us and benefit from our global settlement, and our exchange reduces the cost of sales for the participants by about 40% just by consolidating the shipping. We ship every day between India, Hong Kong, Israel, Dubai, etc., between the diamond centers as an exchange, rather than everyone shipping independently.
Right.
But the other interest for Tiffany's is, for the first time, using the futures or the ETF if they wanted to, they have a vehicle to hedge their inventory risk. Same with Anglo American, Dominion Diamond, Arosa, Lucara, Petra. For the first time, they can hedge, which they never could. And they hedge every other metal that they dig.
Well, it's no different. Like obviously, my PA isn't the size of De Beers, but it's the same concept, right? If I'm going to buy physical, if I'm going to buy digital, and let's get into that next, because in this case, it is different than my gold coins. So American Eagle coin is not digital. Right. Why digital? And you should just kind of go there.
Yeah. So I was around at the very early phase of Bitcoin and very interested. I was quantitative trading, so we were all over it.
It's fun.
And at first, we were using the blockchain for the transparency, right? Because we need to prove to everyone that the contents of this coin are the same as the contents of this coin.
Right.
So we make it all public, and that we made a transparent bid. It came through a regulated venue, exchange. We make all that public on the blockchain so we can prove it. But then we realized we should continue and use the blockchain for the transactions. So inside of every Diamond Standard coin, you can see there's a white layer in the middle. That's a wireless computer chip.
Oh, cool.
And we have a patent on all of this, but that wireless computer chip does three very interesting things. Number one, it provides real-time audit. So while this is at JP Morgan or Dillon Gage, which is our current custodian, the owner can use their phone or their computer and they can talk to their coin. And they can say, "Are you there?" And the coin answers and says, "Yes, I'm here. Don't worry." And you don't have an auditor. You don't need to trust anyone to open up the vault, touch things, and count them. So it's real-time wireless audit. That audit is a 1024-bit encryption challenge, which also means that you can authenticate the coin using the wireless chip. And you can even use your phone. So if I put this in the back of my phone, I can communicate with this coin if it's in my hand, and I can authenticate it face to face. There's also an optical authentication. If you look at the front of the coin, you'll see these spots.
Yep.
And the position of the diamonds are all randomized by a computer.
Oh, cool.
So every coin has a fingerprint optically and a wireless authentication chip. Those two factors make it impossible to counterfeit. But most importantly, that chip stores a blockchain token. that token is inside that chip. It's actually, the circuitry is actually burnt, so it can never be removed or reprogrammed or manipulated. But that coin, that token, is the receipt of ownership. And you don't move the token, but you trade the keys to the token. So while this is sitting at the vault in a whole stack of them, you and I can trade the token, and now you own the vault receipt for that specific coin. That token is actually a huge breakthrough in the blockchain world that people don't know about, but it's a multi-chain token where that token can hop between Ethereum, EOS, Hashgraph, Stellar, Avalanche, Quorum, or any new blockchain that may come up. The benefit of being multi-blockchain is that this is the world's first and only blockchain native commodity. It's built into the blockchain. This is a blockchain address. So I can attach this physical commodity to a smart contract, or I can list it on an exchange with no possibility of fraud that I don't own it, because the commodity itself signs the transaction in real time. It is a real-time blockchain node. So that's a huge breakthrough. What that's going to enable is a crypto and blockchain-based asset that can asset back any other type of contract, whether it's a loan or any kind of agreement. But in the future, we make available a currency where if you own this commodity, you can issue a currency called Bitcarbon, and each coin is a certain number of Bitcarbon, which is the currency unit, and it'll be like a penny or a dime. But that currency works on every blockchain network and has the same value. Whoever owns the currency and issues it through a custodian like BitGo, which is someone we work with, the commodity owner earns a risk-free rate of interest for lending out their currency. That currency works on every platform and has the same value on every platform, but there's an automatic interest system that drives it to wherever it's demanded the most. That new currency is going to be a really big breakthrough.
That is an epic breakthrough. I mean, I think what it also does is it bridges the transparency gap that a lot of people like me, please don't cancel when I say this, on Bitcoin, right? I own Bitcoin, but I can't touch it like you just did and see it, and then most importantly, have a currency translation, and that is awesome. I mean, that and the other big thing is because so it's not only multi-factor, but it's multi-platform. So it doesn't force you to make a bet on one because it's basically multi-blockchain platform is what you just said, I think. So it was. I think
that's right.
That's awesome, man. That's cool. You guys have, and it
only
took you 5 years to do this, man.
That's it. If that currency, we don't talk about it much except with crypto experts, like our people at BlackRock. We're focused just, it's enough. It's the world's first diamond commodity. It's 1.2 trillion. That's enough. But that currency demand, if people do prefer to have an asset-backed currency, which by the way, every currency in history has started as an asset-backed currency. And I love Bitcoin too. Bitcoin has been a great proof of demand and technology. But there's a lot of people who want to have, as you pointed out, I can turn in my Bitcarbon and somebody will put this in my hand. And if the computers get turned off, I still have this under my bed. A lot of people like that.
And just one other point before I take questions. Dylan Engage is your custodian. Did you just choose one for one reason, or are you going to have multiple custodians?
We're going to have multiple. Yeah. So we're working with JP Morgan for our ETF.
Okay.
And one point I should make, the ETF's biggest customers actually are not individuals. It's other ETFs and mutual funds that want to allocate to Diamond as an asset class. They're buying the ETF. But Dylan Gage is a great partner. Also, their subsidiary IDS Delaware. But actually, the main reason we work with them is they're COMEX approved, for our asset backing our CME listed futures, but also they're in Delaware.
Yep.
And Delaware has no state sales tax. So we will when you buy this commodity at our site, which is diamondstandard.co, we will deliver this to you, and you can put it in your sock drawer or in your safe deposit box or your vault. But if we deliver it to you in California, New York, Texas, etc., you have to pay sales tax. If we deliver it to the custodian, which is holding it for your benefit, there's no sales tax. So 98% of our clients have told us they're going to take delivery in Delaware, and they can always take it out whenever they want.
Yeah, I was talking to John Small, who's your COO, of course, and about how VinoVest thought about that. So again, it's like, I want to know that it's there, but I don't have to touch it. So just keep it in Italy. I don't pay any of the duties. I don't pay any of the taxes. And if I want to drink one of those bottles of wine, I'm going to pay all those taxes, and I'm going to realize it upon consumption and delivery. But if I just keep it there, nope, that's good enough for me. So the only thing I have to do is basically trust, like back to your point on why it was only $25 million to begin with, that you don't rip me off and run away with all the money.
Yeah. Well, the other benefit of using the custodian is if you have this in your sock drawer, you can't list it on Coinbase and trade it. It has to be at the custodian.
Okay. Yeah.
Where they can authenticate it.
Okay.
And talk to it, and then you can list your token. So, by the way, the custodial fees are $2 a month. And that provides the online capability, $2 billion Lloyd's of London insurance policy. Believe me, you want to keep it at the custodian.
Yeah.
Some people want to see it, and they just have to know it's real. Fine. But you want to keep it at the custodian. Then you can trade it.
That's cool, man. You guys have solved for a lot of problems, which thank you for going through that in the beginning, because the setup, the lack of transparency, lack of liquidity, et cetera, I mean, that really, obviously gave birth to a great idea that you've put in motion here. I'm going to take some of other people's questions, if you don't mind, because that's what we do. First question, Avery from California. How did you come across blockchain, and how are you using it in Diamond Standard? I think you answered part of that. Also, what are your thoughts on lab-grown diamonds, and what do you think they will have an effect on the future value of diamonds? So maybe the second part of that question, yeah.
Yeah, so I was quantitative trading, and I was actually in high frequency trading when Bitcoin paper came out. So I read it, one of the earlier, probably in the first 6 months of it being published. I was interested. Lab-grown diamonds. First of all of our diamonds that we use are natural, right? And they're UN certified under the Kimberley process. By having this world's first exchange, we're able to enforce fair trade and non-manipulation by the counterparties, et cetera. So there's a lot of benefits of forcing everyone to go through this regulated exchange. There's the efficiency, but also the corporate and social responsibility benefits. Lab-grown diamonds are fantastic, but they're very easy to detect in a lab. So we have no risk of a lab-grown diamond infiltrating our commodity. Every diamond is public, so anyone can research the contents of any coin. Where did those diamonds come from? That's on our website. And what I think will happen is that the diamond prices are going to go up tremendously, because for the first time, you have institutional investors buying up diamonds. And as I said, I think that'll be about 15%. That's before any demand from the currency can take place. I expect that diamonds will become out of reach for normal, consumer level jewelry, not the Cartiers of the world. They will always sell natural diamonds, and the Tiffany's. I think that in the kind of consumer level, mall-based types of jewelry stores, online jewelry, I think a lot more of that will become lab-grown diamonds out of necessity, because the value goes up so significantly. And lab-grown diamonds kind of become like a pair of blue jeans. You wear them for a while, you enjoy them, and then they have no value after you're done wearing them. Lab-grown diamonds already, when they're sold by most vendors, they come with a disclaimer saying, these aren't going to have any value. And if you look over the last 2 years, it's like the reverse of Moore's law, where lab-grown diamonds fall in half every 18 months price-wise.
Really?
Yeah. So
I didn't even know what those were. I mean, so this is why I love these real conversations, because there's a lot I obviously don't know. But lab-grown diamonds, I mean, that doesn't sound like something I should give my wife for Christmas, by the way.
Your wife won't know the difference.
Well, your wife would.
Yes.
So again, these are interesting topics, and this is the beauty of the Real Conversations platform, I think, is that these questions, they get voted up. They come from a lot of different places. This next one's really good. Jim from New Jersey, his deceased father had a jewelry store, so he has a natural interest here. Over the years, there have been many opinions expressed regarding diamond supply being restricted by De Beers to create scarcity of what would otherwise be fairly plentiful. Is that true?
That used to be true. But De Beers got broken up over 20 years ago, and because they used to control the Russian supply and the South African supply. So for the first 30 years of diamonds, De Beers controlled 80-some%. Since then, they control today about 22%. Okay. So they don't control much. And as I mentioned, of that supply, that's only 1.2% stock to flow, where that new supply is negligible compared to the above ground supply. So it's not a, if De Beers withdraws from us completely, and we don't buy rough diamonds, we buy cut diamonds. So we're buying from their customers. But their supply is negligible from our overall supply.
Okay. Cool. And I thought that those were real important. There are a lot of contextual points that you made here. The size of the diamond market relative to the gold market, 30 billion in annual production by the 7 big producers relative to the 1.2 trillion. So I think that those numbers, people now have a pretty good idea, if they didn't already, on what kind of market we're talking about. Here's a good one from Aspen, Colorado. Guy's name's Buck. Cormac, love your diamond standard product. It's brilliant. Already put in a reserve for a coin. By the way, I'll ask the question in a second. Is that what I do? Because if I want to buy one?
Yeah, so
I put in a reserve.
You can reserve it at diamondstandard.co. We don't take the money until the official offering date, which is February 16. But between now and February 16, we're starting the KYC process that we're obligated to do. We have to make sure that there's no money laundering, et cetera, and that we know who our customers are. But yes, if you place a reservation, there's limits. We had to cut back a lot of hedge funds that place big orders. We have a regulatory limit of 1.5 million per customer, but we want to make room for a lot of smaller buyers. And it's selfish, actually, because we need small buyers to sell their coins immediately. Yeah. In order to establish a market price, because we're not permitted to set the fix. So we need someone like Buck to buy 2 coins. It pops whatever, and he says, "Okay, that's enough. I'm going to sell," and then his trade becomes our fix.
How quickly? By the way, I'm going to venture. I mean, Buck's question, by the way, I think is one that you partly answered, which is how did you come to develop an interest in diamonds? And you said your wife's been doing it for, did you say 20 years? Yeah, that's maybe that wasn't your initial interest, but I think you went through that at the beginning. But there's definitely an interesting component to this that is the institutional versus the individual. I mean, particularly in this day and age. I mean, your audience today is all the above. Right. And I think people are quite happy about the democratization of markets. People can criticize it on either side. And that's not what I'm here to do. What people love is having a fair playing field where they can get futures and options data, they can get transparent market pricing, and they can have, in my case, a macro opinion on when they should buy or sell diamonds, and do it themselves. I mean, this is the kind. I would encourage you to have as many individuals as possible, understanding your limits. But at $1.5 million, I guess that basically makes it. Your institutional buyer can't buy a whole bunch anyway right out of the box.
Right. So and institutional investors really are constrained. They often can't buy something that they can't mark to market. So we have some huge institutional pre-orders that will not be participating in the initial offering because they have to wait until the futures are live so they can mark to market. But yeah, so we're definitely making a lot of room for small investors to join in.
That's cool. All right, Daniel from Boston, how do you think about the risk that tech to synthetically manufactured diamonds could tank the price of this asset class?
Yeah, that's not a problem. So natural diamonds take millions of years to grow, and synthetic diamonds take weeks to grow. So at a chemical level, they're identical. At a molecular level, they're not. And so it turns out to be really easy in a gem lab, not at home. Your girlfriend can't tell. But in a gem lab, they run them through ultrasonic equipment that they just zip through. They instantly can tell if a diamond is synthetic. So we've had synthetic sapphires, rubies for 50 years, and they're still at their all-time high price. So we don't think that the synthetic demand has anything to do with the diamond demand. It actually turned out to be a big benefit to us as a company, because it scared all the diamond vendors. They were all concerned that who's going to buy our diamonds? And we said, well, we want to buy them, but we're going to be transparent. And they were afraid of that transparency, that price discovery. So and the labs too didn't want to upset their customers. We work with two of the largest gem labs. They might not have been so willing, and the vendors might not have been so willing if there wasn't the threat of synthetic diamonds potentially undermining their demand. We think the reverse is happening, and now we're going to consume, in this year alone, we expect to consume over 1 billion of natural diamonds from the market.
Yeah, the word synthetic's interesting. I mean, I hear that on the opposite of this Wall Street bets argument, which is basically, it's synthetic, or BS demand is basically what institutions call them. The world just, at least according to me, wasn't drawn up that way. I mean, this is just capitalism 101, bid-ask spread. You're going to realize the price. You're either going to like it or you're not. And for the legacy vendors to feel that way, I'd bet 100% of the time that that's what they would have said initially. But it sounds like they're going to get higher prices for the inventory that they have. So they should be pretty damn happy about what you've done.
It's a lot like decimalization, if you recall. A lot of people were scared of that.
A good point.
But what the result of that was more transaction flow and lower costs.
Yeah.
And that's going to be the benefit. There is some truth, though. As I mentioned, there's a triangle of the diamond industry with the 7 mines. They only have about 200 customers between all 7, and they're called site holders, and they buy the rough diamond. And then you have maybe 10,000, or no, many more than maybe 50,000 small diamond vendors that are trading. And on average, according to Bain, every diamond goes through 5 or 6 hands, from the mine to the wife. And this exchange is disintermediating that supply chain.
Yeah.
Where you have global price discovery, settlement, custody. That diamond can come from wherever it's found to wherever it's needed in one hop. And so it is going to disintermediate the middle of that triangle. It benefits the bottom, which are the Tiffany's of the world, which benefit from price discovery and liquidity.
Mm-hmm. Agreed. All right. One more question here on the. This has to do with the top of that triangle, which are the 7 in particular. De Beers. De Beers is getting plenty of airtime here in the queue. Are the majors, including De Beers, of course, of the view that this market making for diamonds is a positive?
Well, we've informed them that we're coming. There was actually a consortium of the mines that tried to be our investors, and we thought that wasn't a good idea. There's no investors that are, diamond suppliers like De Beers, Alrosa, Lucara, et cetera. We're making the price of everything they have in the ground higher. So from that, they're ecstatic. They're also cautious, though, because we are, for the first time, creating this transparency. Their customers are concerned that De Beers can now have transparency into the price, and so they can squeeze them, and that could be a result. So I think De Beers, as the source of mined diamonds, they only stand to benefit. Everyone else, they they could stand to be squeezed. And I think there'll be a shakeout that the larger diamond vendors that are the site holders, which are usually 100 million to $1 billion companies, they're going to benefit from this efficiency very, very substantially. And this, now that it becomes a regulated commodity and transparent, efficient market, you might see a lot more of those going public, the way you do with gold mining stocks. There really are no public diamond vending companies. So it might unlock a lot of liquidity in the equity of those companies as well.
Interesting. All right, last question. I knew we were going to eventually get a question like this. We should, because we've been talking about the factors, all the components of evaluation here. And the question has to do with ESG factors. Okay, so in addition to the color, the weight, et cetera, like how are people going to want to know that their diamonds weren't made in, blood diamond mining operations?
Yeah. So, we met with the CFTC and they were ecstatic that we were, as they put, we're letting sunlight into this very, very dark market. And that sunlight is a disinfectant where we are, because it's an exchange, it's a member governed exchange, someone has to apply to become a member. They have to agree to ESG characteristics, non-manipulation. Everyone has to adhere to the Kimberley process, which is the UN's program to eliminate all blood diamonds, which has been very successful.
Oh, wow.
All US companies by law must adhere to the Kimberley process, us included. So by creating this focused exchange that all the diamonds must go through, for example, I can't buy diamonds on the phone with a vendor and negotiate a deal. Every diamond we buy has to be a transparent bid on a regulated exchange that we can then prove forever. So that antiseptic is going to serve to really clean up this market. And in the old days, for example, not even the old days, I'm talking about today, if there's a dispute between a buyer and a seller of diamonds, you might have to go to a group of rabbis to get that dispute negotiated. We have an exchange. The exchange has an arbitration process that you as our binding member, as a member, you're bound to that arbitration. So anyway, we're going to clean up a lot of the, dark areas of the diamond supply chain.
Yeah, good on you for doing it that way. I mean, that's really, when you're trying to solve for liquidity problems, lack of transparency, accountability, trust, and you provide something like that, it really goes from being, the darkness to the light. And that's a great way to end what, for me, was a real conversation that I really appreciated. I didn't know almost 100% of what you told me today, so thank you for thanks for putting it within my process too, that or helping me do that, because as soon as I'm allowed to get one of these as soon as I'm allowed to, sounds like I'm reserving a seat on some kind of special place I'm supposed to go, but I get to reserve my coin, right? There's nothing that says because I'm an Irish Catholic I can't go on there and do it, right?
Anybody, and it's first come, first serve. And in our whole blockchain system, we can't favor one customer over another. We built that in, and it's all transparent. That's
awesome. Transparency wins in the end. Thank you very much. I appreciate your time.
Thank you, Keith.
He's Cormac Kinney. That was cool. That was really cool. Thanks for joining us.